Welcome to the Techno Fundamental Report for July 24th. Jack Dreyfus, he was one of the original mutual funds back in I want to say the 60s. During the 12 years he ran the Dreyfus Fund, it returned 604%, more than 100 percentage points better than its closest competitor. Well, realize he dealt in growth stocks and he was also a focused investor. So as I study these guys over the years, I keep seeing that repeating pattern where you got to be in growth stocks and you need to be focused. A bull market is like sex. It feels best just before it ends. Warren Buffett. So you can kind of see with this graph here, you kind of get into a market where we start to get optimism, thrill, euphoria, and then it all kind of comes apart. So you have to use what we call trend following to deal with this issue. Never just buy and hold. Charlie Munger also talks extensively about this, which is, the idea of buying and hold assumes that nothing changes, but things are changing. Like my grandfather, he invested heavily in the passenger rail industry. And he pretty much lost everything. He put everything he had in New York Central in it because it paid a dividend. He convinced me as a young man to invest in Gulf States Utilities because it paid a dividend, but they went under because of the overruns of Riverbend. So things change. You just can't buy and hold. It would be great if that was the case. But, you might hit one and then you miss on another. It's just not the right way to go. I want to talk a little bit about what's going on with the government, just for the heck of it. 90% of federal employees teleworked while taxpayers paid for their empty offices, costing Americans $7.7 billion. Now, what I'm really kind of bringing up here is what's going on with the Federal Reserve. First of all, the Federal Reserve employs 400 PhD economists. And Scott Bessent, who's our Secretary-Treasurer, he doesn't even know what they do. He thinks they just sit around all day. Probably do. But anyway, they conduct research and they analyze and la, la, la. Well, look, the purpose of the Federal Reserve is to bring stability to the economy. And so what Bessent is really talking about here is that have they really been able to do that? Well, let's see. We had the Depression in 29. Now, the Fed was formed in 1910. We'll talk about that. Then you had the Depression in 29, and then you had the Great Recession in 1974. You had the financial crisis in 2008. There's a really big question mark here. Do we really need to have a Federal Reserve, or could we just put the responsibilities with the Treasury? Well, this is kind of what DOGE is all about. They want to cut government spending. Now, the Federal Reserve has approximately 22,000 employees, okay? And they got 400 PhD economists that don't seem to get it right very often. So there's a book that I just started reading. It's 600 pages. I'm about halfway through it. But it's The Creature from Jekyll Island. And what the book is all about is where these major business people, primarily bankers, J.P. Morgan, went to this island off of the coast of Georgia called Jekyll Island. It was real secret. They kept everything very secret. And they wrote the bill for the Federal Reserve Agency. And it was kind of a very controversial idea. Thomas Jefferson was not big on central banks. And the reason is, especially with our central bank, they don't have to answer to anybody. And so as a result, well, let's just kind of look at what's going on right now. Jerome Powell is getting ready to spend $2.5 billion on this tremendous building for the Federal Reserve. Bessent says the Federal Reserve needs to be examined as an institution. So why do they need to spend $2.5 billion? Well, it's actually 2.6, and it's 35% over budget. And he's in trouble with the Congress because he didn't exactly tell the truth about this. So we have a Taj Mahal on the mall, and there's, roughly 75% of the buildings in Washington, D.C. are vacant. So, here we have a guy, and, I was really high on him for a while, but I'm kind of cooling on him because, here we have a guy that's, supposed to bring stability to the economy, and he cannot even handle a budget to do a renovation of his building. I'm kind of lost a little confidence here. Let's look at the market. I think he needs to go. I think we need a new Fed. Well, he's out in May probably anyway. Okay, NASDAQ, again, we saw that low April the 7th. We're continuing in an uptrend. We're basically making new highs. NASDAQ looks good. Everything looks good here. S&P 500, same thing, made the same low, starting to work its way up. Now, remember now, 3 out of 4 stocks will follow the indexes. But with focus investing, what you're trying to do is to find that one outlier or maybe 2 outliers out there that can really make a difference in your portfolio. I'm talking like Google, Apple, Walmart, those kind of things. All right, primary trend is up. In fact, we're hitting new highs. Looks very good. We're above the 200-day moving average. Very, very positive. Now, I wanted to mention here on this particular graph, I never have mentioned this, but this is a 50-day moving average of the new highs on the S&P 500. So this isn't the actual number. See, the actual number was like it had 25 new highs today, but the moving average right now is at 20.96. But all I'm really pointing out here is that, we got this upturn. We got this upturn. Now we're getting this upturn. Now realize we're at roughly 20% of the S&P hitting new highs, but when the market has peaked in the past, we get up to 60, 70% of the S&P stocks hitting new highs. So if this is the beginning of something, I hope it is. Okay, I also took another shot at our aggression index. Now what I'm doing here is I've got the technology stocks divided by the consumer staples. Well, excuse me, on this graph I'm doing the S&P 500. So I'm taking the aggressive technology stocks and the broadly diversified S&P 500. Now, I'm then doing this on a weekly basis, and I'm using the 200-week moving average. So you can see here, with this particular indicator, it will come down. We go into a downtrend. You can see here the market doesn't do well. This is a good indicator. I'm telling you, this is a good one. So it came down that 200-week and held and turned up. Then we get to where we are now, and we've basically gone into a downtrend. We got down to that 200-week moving average, pretty much held. Now we're starting to rally again. So you can see that when we rally, the market tends to do pretty well. So you want to be in growth stocks, and technology is the primary growth leader. Now, interest rates. Now, what I've done here is I've just gone back to 2022, 2023, and just to show how stable the yield on the 5-year Treasury yield has been. It hadn't been crazy. It's not like the 1970s. Also, we have something called the Power Index, where we measure how much this interest rate has changed over the last 125 trading days. Well, interest rates have dropped by 11.12%. So we're below zero, which is very positive, and it usually indicates the Fed, if we ever have a Fed that'll do anything, will cut interest rates. Now, the volatility index, the VIX, is really looking good to me because you're in a downtrend here. You've got a high, a lower high, a lower high, lower high, lower low, lower low, low, low. So it is a downtrend. So when volatility goes down, that means the markets are stable, and that's what you want. Crude oil, if we were going to have rampant inflation due to the tariffs or whatever, I just don't think crude oil will be dropping. So it's back in a downtrend again. It's been in a downtrend for a while, but it's starting to turn back down. So oil is, I would avoid energy right now. New lows on the New York Stock Exchange, well under control. We're doing perfectly fine here. So the sellers have pretty much dried up. Now I just wanted to pick one stock. This is GE Vernova. They announced earnings today. The stock broke out. So let's just learn something here. So we've got a stock. It's definitely, you never want to buy a stock in a downtrend. You always want to buy a stock in an uptrend. So then we get what we call a gap up. So it's where the stock breaks out in an abnormal fashion. So you can see here that, this stock, tends to trade pretty tightly. But then all of a sudden you get this abnormal action and you get volume. The average volume is 3.1 million. So you want to do 150% of that. So that would roughly be 1.5. So it'd be about 4.6 million shares traded in order to qualify for a gap up. Well, it traded over 6 million shares. So this is an interesting play. You would use a stop at the bottom of the gap up. So in other words, if the stock turns around and comes back down here, you got to get out. But if it starts to stabilize and actually gives a new buy signal, that's good too. But I would say maybe even take a little bit of a stab here and just use that stop and just do it lightly. So if you have any questions, please let me know. Thank you very much.